For over 7 decades, the US dollar has held an almost unchallenged position as the world's primary reserve currency. From global trade settlements to foreign exchange reserves, almost every nation relied on the dollar as a symbol of stability and trust. This dominance allowed the United States to borrow cheaply, finance massive deficits, and influence global economic policies with ease. But that era is showing cracks. Mounting national debt, combined with repeated rounds of quantitative easing, has devalued the purchasing power of the dollar. Inflationary pressures have eroded savings and shaken confidence in the currency, even among longtime allies. Geopolitical tensions further complicate the picture. Nations like China, Russia, and India have begun openly reducing their reliance on the dollar for international trade. Bilateral agreements are increasingly conducted in local or alternative currencies, signaling a gradual shift away from the dollar-centric system. Moreover, technological innovations in digital currencies and central bank digital currencies, CBDCs, are providing governments and corporations new tools to bypass the dollar altogether. These innovations challenge the traditional banking system and threaten to erode the dollar's influence in cross-border transactions. The end of dollar dominance is not an immediate collapse, but rather a slow erosion of trust and influence. The global economy is beginning to prepare for a future where multiple currencies share influence, reducing the leverage the United States has enjoyed for decades. For investors, businesses, and ordinary citizens, this shift signals a need to rethink strategies, diversify holdings, and understand that the era of unquestioned dollar supremacy is coming to an end. In short, the foundation that has supported the world's financial system for decades is weakening, and the stage is being set for a new, multi-currency global order. As the dominance of the US dollar begins to waver, regional currencies are emerging as serious alternatives for global trade and financial influence. Nations are increasingly looking to strengthen local or regional monetary systems to reduce dependency on the dollar and protect themselves from external shocks. The euro, Chinese yuan, and other regional currencies are at the forefront of this transformation. The Eurozone, despite internal challenges, remains a major economic bloc, with the euro serving as a viable alternative to the dollar for cross-border transactions within Europe and with other trade partners. By settling trade deals in euros, European countries are asserting greater financial autonomy and signaling that they can operate independently of US monetary influence. Meanwhile, China has been aggressively internationalizing the yuan. Through initiatives like the Belt and Road Initiative and bilateral trade agreements, Beijing is promoting the yuan as a preferred currency for Asian, African, and Latin American nations. This move is strategic. It allows China to strengthen its economic ties globally while reducing exposure to the fluctuations and political influence of the dollar. Other regions are following suit, creating financial ecosystems around local or resource-backed currencies. For instance, Middle Eastern nations are exploring currencies tied to oil or other commodities, while some African economies are experimenting with regional digital currencies to facilitate trade across borders. The rise of regional currencies is not just about convenience. It represents a shift in global economic power. By decentralizing currency dominance, nations gain leverage over trade negotiations, reduce vulnerability to dollar fluctuations, and create more stability within their own regions. As these regional currencies gain traction, the world is slowly moving toward a multi-currency system, laying the foundation for the eventual division into distinct money zones. In short, the rise of regional currencies marks the beginning of a new era, one where economic influence is no longer concentrated in a single global currency, but spread across multiple financial spheres. The global economy is gradually moving toward a reality where a single currency no longer dominates. Instead, experts predict the emergence of 4 major money zones, each controlled by a regional powerhouse. These zones will not only shape trade and investment patterns, but also redefine geopolitical influence. Understanding these zones is crucial to grasp how the world's financial architecture is shifting. The first zone centers around the United States and its allies, where the US dollar will still retain significant influence. This zone will include North America, select parts of Europe, and other dollar-dependent economies. Despite weakening dominance, the dollar remains deeply embedded in global finance, serving as a reserve currency and a primary medium for international trade. Nations within this zone will continue to rely on the stability and liquidity of the dollar for cross-border transactions. The second zone is led by China and focuses on Asia-Pacific nations. Anchored by the yuan, this zone aims to reduce reliance on the dollar and create a self-contained financial ecosystem. With initiatives like the Belt and Road and the creation of digital yuan platforms, China is positioning itself to dominate regional trade settlements, infrastructure financing, and technological investments. The third zone emerges in Europe, primarily around the euro. While smaller than the US and China zones, the Eurozone maintains significant trade and investment clout. Nations here are increasingly seeking financial independence from both the dollar and the yuan, emphasizing cross-border trade within Europe and partnerships with other regions using euros. The fourth zone will include resource-rich regions like the Middle East and parts of Africa and Latin America. Currencies here may be tied to commodities like oil, minerals, or new digital assets, creating localized financial systems that operate independently of the major powers. Ultimately, the world is transitioning from a unipolar financial system to a multipolar one. Each zone will act as a self-reinforcing ecosystem, dictating trade rules, investment flows, and economic alliances. The rise of these four money zones signals a profound restructuring of global power, with currency as the ultimate tool of influence. The emergence of four distinct money zones will have profound implications for global trade and finance, reshaping the way countries, corporations, and individuals conduct business. One of the most immediate effects will be the reduction of reliance on a single global currency. Today, the US dollar dominates nearly every major international transaction, from oil to technology exports. In a multipolar currency system, trade agreements will increasingly settle in regional currencies, forcing companies to manage multiple exchange rates and hedging strategies. For global businesses, this transition will mean more complex financial planning. Multinational corporations will need to navigate the varying monetary policies, interest rates, and capital controls of each zone. Supply chains may shift geographically to align with currency stability, and investments will increasingly flow toward regions with predictable monetary frameworks. Companies operating in multiple zones will face both opportunities and risks as regional currencies rise or fall in response to political decisions, resource scarcity, or economic growth. Countries outside the major zones may feel pressured to join one of the four, align their monetary policy, or risk financial isolation. For instance, nations in Africa or Latin America might pivot toward resource-backed currencies, digital currencies, or regional trade agreements, creating new spheres of influence. The financial markets will also experience volatility. Forex trading, international bonds, and commodity pricing will reflect the dynamics between the zones. Traditional safe haven assets like the US dollar or gold may lose dominance, while regional currencies gain strength. This could lead to short-term instability, but also offers opportunities for nations and investors to diversify portfolios and reduce dependence on a single dominant currency. Ultimately, the rise of four money zones will create a new era of economic competition, forcing global actors to adapt or risk being left behind. Understanding these changes is critical for anyone who wants to navigate the shifting landscape of international finance successfully. As the world fractures into four distinct currency zones, individuals and businesses must proactively prepare to protect wealth, maintain liquidity, and capitalize on emerging opportunities. For individuals, diversification will be key. Holding assets across multiple currencies and regions can mitigate the risks associated with a single zone collapse or rapid devaluation. Investments in precious metals, cryptocurrencies, and regional exchange-traded funds may serve as hedges against sudden monetary shocks. Businesses, particularly those engaged in international trade, will need to adapt their financial strategies. Managing multiple currency accounts, employing dynamic hedging strategies, and renegotiating supplier contracts to include flexible currency terms will be essential. Companies that fail to adjust risk management practices may face unexpected losses, whereas those who plan ahead can gain a competitive advantage. Technology will play a critical role in navigating this new reality. Digital payment platforms, blockchain-based financial tools, and AI-driven currency management systems can help track and optimize exposure across zones. Staying informed about geopolitical shifts and central bank policies in each zone is equally important. Finally, flexibility and agility will be vital. Both individuals and businesses must be prepared to move funds, shift operations, or adjust pricing strategies as currency values fluctuate. By embracing diversification, leveraging technology, and maintaining a proactive approach, they can not only safeguard their assets but also thrive in a multipolar financial world, turning potential instability into opportunity.